What's good, family? In this video, you will learn the definitions, differences, pros, and cons between ETFs, mutual funds, and index funds. And at the very end of this video, I'm going to go over which investment vehicle is right for you. I'm Sean, a data scientist who teaches people about investing for financial freedom. Bop the like button and let's begin. You may have seen my video on the only stock you ever need to invest in, and there we learned that investing in individual stocks is extremely high risk and that 95% of financial professionals can't even beat the stock market anyways. You may hear stories about people doubling, tripling, or even quadrupling their money, but for every success story, there are way more sob stories. I don't want to be sobbing, I don't want you to be sobbing, so to mitigate risk, grow with the market, and to free up all of our time from researching individual stocks and paying attention to the market, we invest in index funds. An index fund is an investment vehicle that tracks an underlying market. For example, the S&P 500 index will contain the top 500 US companies. If you buy an index fund that tracks the S&P 500, you're purchasing a fund that contains the largest 500 US companies. There are many markets an index fund could track, such as the total US stock market, total international stock market, and specific sectors such as the technology sector. Index funds are a fantastic investment choice because it offers investors a broad, diversified way to invest in markets. If any question popped in your head, leave a comment down below and I will get to it. Now that we understand what an index fund entails, let's bring in two terms: ETFs, or exchange traded funds, and mutual funds. Both ETFs and mutual funds are professionally managed baskets of individual stocks or bonds. Most ETFs are index funds. They track a certain market. Mutual funds may or may not be index funds. And from here, we have to break down mutual funds into two terms: mutual funds and low-cost index funds. Mutual funds have the goal of beating the stock market and earning lots of money. Mutual funds are managed by a portfolio manager with a team of research analysts behind them. Because mutual funds are actively managed with numerous people doing research all of the time, their fees are very steep. On the other hand, low-cost index funds aim to closely follow a market, are passively managed, and therefore have much lower fees. Because over the long term, it's nearly impossible to beat the stock market and the high fees associated with mutual funds, I personally do not invest in mutual funds. It's nearly impossible to beat the market. The only thing we can control are the fees associated with our portfolio. It's challenging to beat the stock market, and the only thing that we can control are the fees we pay for our funds we hold. A low-cost index fund that I invest in is VTSAX, and an ETF that I really like and also invest in is VTI. Both are total US stock market index funds and contain every single publicly traded US company. So buying one of these two funds means you're investing in the entire US stock market itself. Both are professionally managed by Vanguard and have crazy low fees. Let's lay out the differences between ETFs, mutual funds, and low-cost index funds. The goal of an ETF is to track the market that it is following. The goal of a mutual fund is to beat the stock market. The goal of a low-cost index fund is similar to an ETF and just tracks whatever market that it's following. ETFs can hold a variety of things such as stocks, commodities, and bonds. ETFs have more options for investors than mutual funds and low-cost index funds. With ETFs, you will find sector-specific funds that track the healthcare industry, the technology sector, financial sector, and many more. They even go industry specific, such as the airline industry. So purchasing an airline industry ETF means you're investing in companies associated with the airline industry. Mutual funds will hold stocks, bonds, or whatever the portfolio manager wants to hopefully beat the stock market. Low-cost index funds will also hold stocks or bonds to track whatever market they're following. The minimum investment for an ETF is whatever the market price is at a certain time and day. The market price is just the amount of money buyers are willing to buy and sellers are willing to sell an individual stock at a certain time of day. With the example of VTI, the market price is around $165. This means you need $165 to invest in that ETF. Most ETFs are between $50 and a couple $100. Mutual funds have higher minimums between $500 to $5,000 or possibly even more. Low-cost index funds also have a high minimum where VTSAX requires an investor to have $3,000 to initially buy that fund. Fractional shares makes it possible for investors to purchase an ETF or a stock if they have less money than the market price. There are few investment platforms out there that offer fractional shares for investors. Robinhood has it for select few investors, but one platform that has it for everyone is M1 Finance. With M1 Finance, all you have to do is invest an initial $100, and from there you can invest in whatever combination of stocks or ETFs you would like. This means at a minimum, you would need $100 for the initial investment, and then you can invest $10 into whatever ETF you would want, such as VTI. Even with $10, you can buy VTI. Link in the description for M1 Finance where you can get your first $10 free. Mutual funds and low-cost index funds also have fractional shares after you meet that initial minimum deposit. So with VTSAX, after you reach $3,000, you can invest any amount of money you'd like, such as $100 or even $10 into VTSAX, and it will purchase fractional shares of that fund. ETFs are traded during the day much like stocks. There are many sophisticated order types, but the most simple order type is the market order, which gets you the best current price. Mutual funds are priced at the end of the day, so no matter when you purchase a mutual fund, you will purchase it at the end of the day at 4 p.m. Eastern. Between ETFs, mutual funds, and low-cost index funds, there are no commissions for buying those funds. In the example of VTI, it has an expense ratio of 0.03%. This is the annual fee you pay to Vanguard to professionally manage your fund. Because VTI is passively managed, this expense ratio is very low. Mutual funds have a much higher expense ratio because the fees goes towards a team of research analysts and portfolio managers going to different business CEOs to see how their companies are doing. For a mutual fund, you will typically see a 1% expense ratio. This is multiple times more than an ETF. For a low-cost index fund, the expense ratios are similar to an ETF, where VTSAX has a 0.04% expense ratio, and some low-cost index funds, such as the ones at Fidelity, will have a 0% expense ratio. Before fractional shares became a thing, you could not automate your contributions and your investments into ETFs. But now that fractional shares do exist, you can automate away, say, $500 every single month into M1 Finance and fully invest that $500 into the ETF of your choice. Mutual funds and low-cost index funds also have automatic investments where you can contribute, invest, and withdraw automatically whenever you would like. With mutual funds and index funds, you can set up DRIP or a dividend reinvestment plan. A dividend is money companies pay to their investors from time to time. With DRIP, you can automatically have those dividends reinvested into the fund. So to summarize everything, you should invest in an ETF if you have less than the minimum required amount of money for low-cost index funds. In the example of VTSAX, there's a minimum of $3,000, so if you don't have $3,000, you have really no choice but to invest in ETFs. If you want niche exposure, you should purchase an ETF and weight your stock portfolio towards the specific industry or sector you want. With ETFs, you generally have more control over what you have in your portfolio. You should also invest in ETFs if you can purchase fractional shares. You should invest in mutual funds you really shouldn't. You should invest in low-cost index funds if you have that minimum amount of money to purchase it. For VTSAX, it's $3,000. If your investment platform of choice has a low-cost index funds that you like and it has a low expense ratio, then you should purchase it. If your investment platform does not have fractional shares for stocks or ETFs whatsoever, then you should invest in low-cost index funds. The ability to purchase and sell an ETF like stocks creates this temptation to trade, and this leads to potentially damaging investment decisions. such as market timing, frequent trading, and simply just wasting a lot of time investing. Investing should be done passively where you don't have to worry about your investments that much. An investor can wisely use both ETFs and low-cost index funds. You may have a total US stock market index fund such as VTSAX make up the bulk of your stock portfolio, which is a stable way to track the US stock market over the long term. And then if you wanted more niche exposure, so you wanted to invest more heavily into specific sectors such as technology or the airline industry, you can then add in ETFs. In the end, as long as the ETF or low-cost index funds contain many companies and is therefore diversified, you can't go wrong with investing in either. I want your opinion. Do you like ETFs, mutual funds, or low-cost index funds more? Let's continue this conversation, and I will see you all in the comment section below. Peace.